Trading is one of the most mentally demanding activities a person can engage in, and the reason most people fail has nothing to do with their strategy or their tools. It has everything to do with their mindset. The market does not care about your feelings, your financial goals, or how badly you need a winning trade. It moves based on the collective behavior of millions of participants, institutions, algorithms, and global events. The moment you try to fight it, predict it with certainty, or force it to give you money, you have already lost. The real secret that professional traders know but rarely share is this: your job is not to beat the market. Your job is to flow with it, to read it, and to respond to what it is actually doing rather than what you hope it will do. The biggest enemy in trading is not a bad strategy. It is emotion. Fear and greed are the two forces that destroy more accounts than any market crash ever could. Fear makes you exit a perfectly good trade too early because you are afraid of losing a small profit. Greed makes you hold a winning position too long because you want just a little more, until the trade reverses and that profit disappears. Fear also makes you hesitate on a valid setup because your last trade was a loss, and greed makes you enter a trade that has no real basis, just because you feel like the market is moving and you are missing out. Both of these emotions feel completely rational in the moment. That is what makes them so dangerous. Every bad trading decision feels justified when you are making it. Professional traders develop what is called emotional neutrality. They do not celebrate big wins or despair over losses. They treat every trade as just one instance in a long series of trades. This perspective is fundamental. When you understand that trading is a probability game played over hundreds or thousands of trades, a single loss stops feeling catastrophic. It becomes data. It becomes information. It tells you something about the market, about your setup, about your timing. Traders who have been in the game for years will tell you that their ability to lose well is what separates them from beginners. Accepting a loss quickly and cleanly, without revenge trading, without doubling down, without emotional reaction, is genuinely one of the hardest skills to develop and one of the most valuable. Here is something that surprises most new traders. The best traders in the world do not have high win rates. Many consistently profitable traders win only 40 to 50% of their trades. That means they are wrong more often than not, and they still make money. How? Because they manage their risk so tightly and let their winners run so effectively that the math works in their favor over time. This completely destroys the beginner belief that you need to be right most of the time to succeed. You do not. You need to be disciplined most of the time, which is a very different thing. Another mindset shift that changes everything is the idea of approaching every trade with genuine humility. Before entering any position, you need to be completely comfortable with the thought that you might be wrong. Not probably wrong, not definitely wrong, but possibly wrong. The market can always do something unexpected. News breaks, institutions shift positions, liquidity gets taken out. When you enter a trade with the attitude of certainty, you resist the signals that tell you the trade is failing. You hold on too long, you move your stop loss, you add to a losing position. All of these behaviors come from ego, from the unwillingness to be wrong. The trader who says, "I might be wrong, and here is my exit plan if I am," will always outlast the trader who says, "I know this is going up." Patience is the final piece of the mindset puzzle. Most traders overtrade. They sit in front of their charts for hours and feel compelled to act, as if doing nothing means they are failing. But the market does not reward activity, it rewards precision. Waiting for the exact right setup, even if it only appears twice a week, is infinitely more profitable than trading every movement you see. The market will always be there tomorrow. Your capital, if mismanaged, will not. Walk into any trading forum or watch any beginner trading video and you will see the same thing. Charts covered in colorful lines, oscillators at the bottom, moving averages crossing each other, RSI, MACD, Bollinger Bands, Fibonacci retracements stacked on top of each other until the actual price is barely visible. Beginners believe that more indicators mean more information, and more information means better trades. This is one of the most common and most costly misconceptions in trading. The truth is the opposite. More indicators create more noise, more confusion, more contradictory signals, and more reasons to second-guess yourself. The real secret is that price itself tells you everything you need to know if you learn how to read it. Price action trading means reading the raw movement of price on a chart without relying on lagging indicators to tell you what has already happened. Every candlestick on a chart represents real human and institutional behavior. It shows you where buyers stepped in and where sellers pushed back. It shows you who is in control of the market and where that control is shifting. When you train your eye to read this language, the chart becomes a story rather than a puzzle, and that story tells you where the market is likely to go next based on where it has been and how participants have reacted at key levels. Support and resistance are the foundation of price action. Support is a price level where buying pressure has historically been strong enough to stop price from falling further. Resistance is a level where selling pressure has consistently pushed price back down. These levels form because the market has memory. Institutions and large traders who bought at a certain level will buy there again if price returns to it. Traders who missed an entry will wait for a second chance. Traders who are in losing positions will look to break even when price comes back. All of this creates predictable behavior around key levels, and identifying these levels correctly is the single most important technical skill you can develop. Trend structure is equally important and equally simple. A market that is making higher highs and higher lows is in an uptrend. A market making lower highs and lower lows is in a downtrend. That is it. You do not need an indicator to tell you this. You can see it with your eyes. The mistake most traders make is trying to trade against the trend because they think the move has gone too far. But trends persist far longer than logic suggests they should, and fighting a strong trend is one of the fastest ways to drain an account. Candlestick patterns at key levels are where price action becomes truly powerful. A pin bar is a candle with a long wick and a small body, and it represents rejection. When you see a pin bar forming at a major support or resistance level, it tells you that price tested that level, got rejected hard, and reversed. This is not random. It is the footprint of large players defending a level. An engulfing candle, where a large candle completely swallows the previous one, signals a shift in momentum. These patterns are not magic, but they are meaningful when they appear in the right context at the right levels. Volume adds another layer of confirmation. Price movements on high volume are more significant than the same movements on low volume. A breakout of a resistance level on massive volume tells a completely different story than the same breakout on thin volume. High volume means conviction. It means large players are participating. Low volume breakouts often fail and reverse because there is not enough institutional commitment behind the move. The simplicity of price action is actually why most traders ignore it. They want something more sophisticated, something that feels like a secret code. But the real secret is that the code is right there on the chart in the raw price movement, and learning to read it with clarity and patience is a skill that will serve you better than any combination of indicators ever could. If you ask most beginner traders what they think the key to trading success is, they will talk about finding the right strategy, identifying the perfect entry point, or having access to insider information. Very few will mention risk management, and that tells you everything about why most traders fail. Risk management is not the exciting part of trading. It does not give you stories to tell about massive wins. It does not feel like a skill when you are learning it. But it is, without any exaggeration, the single most important factor that determines whether a trader survives long enough to become profitable. Without it, even the best strategy in the world will eventually destroy your account. The core principle of risk management is simple. Never risk more than you can afford to lose on a single trade. In practice, this means risking a fixed percentage of your total trading capital on every trade, regardless of how confident you feel about the setup. The most widely used standard among professional traders is the 1 to 2% rule. This means if you have a $10,000 account, you never risk more than $100 to $200 on any single trade. This sounds conservative to beginners who want to grow their account quickly, but it is this conservatism that keeps professionals in the game through losing streaks that would wipe out less disciplined traders. The math behind this rule is powerful. If you risk 2% per trade and you hit 10 losing trades in a row, you still have over 80% of your capital. You are bruised, but you are alive. You can recover. But if you risk 10% per trade and hit 10 consecutive losses, which is completely possible even with a good strategy, you have essentially nothing left. The difference is not strategy. It is position sizing. Two traders with identical strategies but different risk management will have completely different outcomes over time. Risk to reward ratio is the other pillar of professional risk management. Before entering any trade, you should know exactly where your stop loss is and exactly where your target is, and the potential reward should be at least twice the potential risk. This is the 1 to 2 risk-reward ratio minimum. Why does this matter so much? Because with a 1 to 2 ratio, you only need to win 1/3 of your trades to break even. Win 40 or 50% and you are consistently profitable. This is how traders with modest win rates still make money systematically. They are not smarter than the market. They are simply structured in a way that the math favors them over time. The stop loss is perhaps the most misunderstood tool in trading. Beginners often see it as an admission of defeat, a sign that they are not confident in their trade. Professionals see it as insurance, as the predetermined price at which they have decided the reason for the trade no longer exists. A stop loss is not something you move when the market gets close to it. Moving your stop loss further away because you do not want to take the loss is one of the most destructive habits a trader can develop. It transforms a small, planned loss into a potentially catastrophic one. Consecutive losses deserve special attention because they trigger some of the worst trading behavior. After 2 or 3 losses in a row, many traders feel the urge to make it back immediately. They increase their position size, they take trades that do not meet their criteria, they chase price. This is called revenge trading, and it almost always makes things significantly worse. Professional traders have rules about this. Some stop trading after 3 consecutive losses for the day. Some reduce their position size after a losing streak until they regain confidence. The discipline to step away when things are not going well is as important as the discipline to execute well when they are. Risk management will never make you a trading legend. It will not give you the story of the trade that turned $1,000 into $1 million. But it will give you something far more valuable: longevity. And in trading, longevity is everything. The longer you stay in the game with your capital intact, the more you learn, the more your skills develop, and the more opportunities you have to build real, lasting wealth. There is a version of the market that retail traders see, and then there is the version that actually drives price. Understanding the difference between these two realities is what separates traders who consistently struggle from those who consistently profit. The retail trader looks at a chart and sees patterns, trends, and indicators. The institutional trader, the hedge fund, the investment bank, the entity moving hundreds of millions of dollars at a time, sees something entirely different. They see pools of liquidity, clusters of stop losses, and inefficiencies in price that they can exploit to fill their massive positions. Once you understand how these large players operate, the market starts to make sense in a completely new way. The concept of liquidity is central to understanding smart money. Liquidity refers to the availability of orders at certain price levels. When a large institution wants to buy $1 billion worth of an asset, they cannot simply place that order and have it filled instantly without moving the price dramatically against themselves. They need a large number of sell orders to absorb their purchase. Where do those sell orders come from? They come from retail traders who have placed stop losses below recent lows or above recent highs. This is why you so often see the market dip just below a key support level, trigger a wave of stop losses from retail traders who went long, and then immediately reverse and shoot upward. The institution used those stop-loss orders as the liquidity they needed to build their long position. This behavior is called a liquidity hunt or a stop hunt, and once you see it, you cannot unsee it. The market moves to where the orders are, and retail traders, by placing their stops at the most obvious levels, such as just below a round number or just below the previous swing low, are essentially advertising their orders to the market. Smart money knows exactly where these stops are, because they are at the most logical and most commonly taught levels. So they engineer brief moves to those levels, collect the liquidity, and then move in the direction they were always going to go. False breakouts are a direct application of this same principle. When price breaks above a key resistance level, retail traders who have been trained to buy breakouts rush in. They are excited, the move looks confirmed, but in many cases, this breakout is engineered. Smart money is selling into that buying pressure, distributing their positions to the retail traders who are eagerly entering long. Once enough retail traders have bought and smart money has sold what they wanted to sell, price reverses sharply. The retail trader is now trapped in a losing long position, while the institution profits on the move down. Accumulation and distribution are the two phases of smart money positioning that happen before any major price move. Accumulation is the quiet phase where institutions are slowly buying over an extended period, often when price is moving sideways in a range and volume appears low. The market looks boring during this phase, which is exactly what smart money wants. They do not want retail traders to notice what is happening. Distribution is the opposite, where institutions are selling their positions into strength, often when everyone is excited about a trend and retail traders are buying enthusiastically. By the time the mainstream sees an asset as a great buy and jumps in, the smart money has already bought and is now selling to them. News events deserve special mention in the context of smart money. One of the most consistently observed phenomena in trading is that bad news causes a market to go up and good news causes it to go down. This seems to defy logic until you understand institutional positioning. If smart money has accumulated a large long position in anticipation of an event, they need retail traders to sell to them during the news event so they can absorb the selling pressure. Bad news triggers retail selling. Smart money buys that selling. Price goes up. The opposite happens at market tops. Understanding this does not mean you trade every news event, but it does mean you should never assume that an obvious news catalyst will produce an obvious price move. Every trader who has ever blown an account, and most experienced traders have blown at least one, can point to a moment where they abandoned their plan. Maybe they held a losing trade too long because they were sure it would come back. Maybe they skipped their analysis one morning and traded on impulse. Maybe they saw a big move happening and jumped in without any real setup, because the fear of missing out was overwhelming. The trade itself is rarely where the real mistake happens. The real mistake happens before the trade, in the absence of preparation, structure, and routine. Consistency in trading does not come from finding the perfect strategy. It comes from building a professional framework around your trading and adhering to it with the same discipline every single day. A trading plan is not optional for serious traders. It is the document that defines who you are as a trader before the market opens and before your emotions have any chance to influence your decisions. Your trading plan should specify exactly which markets you trade, which timeframes you analyze, what conditions must be present before you will consider an entry, where your stop loss will be placed, where your first target is, and when you will close a trade regardless of whether it has hit your target. Every single one of these decisions should be made in advance, in a calm state, not in the heat of the moment while price is moving. Traders who make decisions on the fly are gamblers. Traders who execute a predefined plan are professionals. The trading journal is the tool that most consistently separates improving traders from stagnant ones, and it is also the tool that most traders skip because it feels tedious. A trading journal is a record of every trade you take, including the setup you saw, the entry price, the stop loss, the target, the outcome, and most importantly, your emotional state and thought process during the trade. Over time, your journal becomes your most valuable asset. It shows you which setups are actually working for you and which ones you just think are working. It shows you the times of day when your performance is strongest. It reveals patterns in your mistakes that you would never notice without a written record. Reviewing your journal weekly is how you turn experience into genuine improvement rather than just repeating the same mistakes for years. Session timing is a practical knowledge gap that costs many traders real money. Not all hours of the trading day are equal. The Asian session tends to be slow and range-bound. The London session, which opens in the early morning European time, brings significant institutional participation and often sets the directional bias for the day. The New York session, particularly the overlap with London in the first few hours, is where the highest volume and the most significant price moves consistently occur. Trading during low-volume hours means wider spreads, less predictable price action, and more stop hunts. Trading during high-volume sessions means tighter spreads and more reliable follow-through on setups. Simply focusing your trading activity on the highest quality hours of the day can dramatically improve your results without changing anything else. Backtesting is how you validate your strategy before putting real money at risk, and yet most retail traders never do it properly. Backtesting means going back through historical chart data and manually identifying every instance where your setup would have appeared, recording what would have happened if you traded it, and calculating your win rate, average risk-reward, and overall profitability across a statistically significant sample of at least 100 trades. This process is time-consuming and unglamorous, but it gives you something priceless: genuine confidence in your approach. When you know from data that your strategy has a positive expectancy over a large sample, you can execute your trades without the crippling self-doubt that causes most traders to deviate from their plan at the worst possible moments. The final and perhaps most important execution principle is the discipline of doing less. The market presents an endless stream of movement, and the temptation to trade constantly is enormous. But overtrading is one of the most common ways traders destroy their accounts. Not because each individual trade is catastrophic, but because transaction costs accumulate, mistakes compound, and decision fatigue sets in after too many hours of screen time. The professionals who have been in this game for decades will consistently tell you the same thing. They wait for the highest quality setups, sometimes just 1 or 2 per day, execute them with precision, and then leave the market alone. Less trading, better trading. That is not a beginner's limitation. That is the advanced approach.